In this example, we consider an unannounced temporary increase in the domestic money supply. That is the nominal stock of money under a flexible exchange rate regime. Now, temporary has a specific meaning in my class. We're going to assume it's so temporary that prices don't have enough time to adjust. So, in this case, this is all on the domestic side of the economy. So the foreign market, the foreign money market, doesn't move. The money supply here doesn't move, the interest rate here doesn't move, and the money demand curve doesn't move. So as a result, the time paths for all the foreign variables are going to be constant. So I'm just going to draw all of them now. And we're done with that whole side of the market. So really, this is about the domestic money market and the foreign exchange market. Now, an increase in the nominal stock of money increases the money supply to here. The effect of that is to lower the interest rate. When we graph that, the time path, we see that money supply is increased, but it's temporary. So it eventually returns to its old level. Because it's temporary, by assumption, it only lasts long enough to change and come back, but not long enough to affect the price level, so this doesn't move. Because this little m is big M divided by P, here we see that the numerator increased and then fell back here. The interest rate dropped and then returned to its old level. So we get time paths that look something like that. Pretty boring. Over here, it's so temporary that the interest rate moves and comes back, but nothing else has time to adjust. So in this case, what happened to the interest rate? It declined. So it went from here to here. When it did that, the exchange rate rose. And then it came back. So this rose and then fell back. End of story. Now, what we can see is that there was a temporary decrease in the value of domestic currency. That's reflected in this drop in the interest rate temporarily and this rise in the exchange rate. Don't forget, an increase in the exchange rate is a depreciation in the domestic currency.